Good afternoon. Today we are learning everything about double entry bookkeeping and posting in a ledger.
To have some motivation about the topic we are going to learn today, let us indulge this quote from Henry David Thoreau.
Wealth is the ability to fully experience life.
Now, are your minds ready to learn more about double entry bookkeeping and posting in a ledger?
Makes me wonder, why do we need to study these topics anyway?
Here are some reasons why.
Accuracy,
Error reduction.
Leaving an audit trail,
Financial statement preparation.
Now you may wonder, what about the importance of posting in a ledger?
The following are the benefits of posting a ledger.
Figuring of profit or loss.
knowing the definite situation of an account.
Imperative.
Time saver.
So now, are you ready to really know everything about bookkeeping?
If yes, keep on listening.
Let us start off with the basics of what is double entry bookkeeping.
Double entry bookkeeping in accounting is a system of bookkeeping so named because every entry to an account requires a corresponding and opposite entry to a different account. In double entry accounting, any transaction in one account requires an equal and opposite entry in another account. For managing a business, it is just as important. In the double entry bookkeeping system, you will record two entries for each transaction, a debit and a credit.
We've been talking about ledgers for a while now, but we don't even know what a ledger is. Don't you worry, I always got you. General ledger is a record used to sort and summarize business transactions. Always remember that in writing a ledger, debit and credit must always stay balanced.
They are equal but opposite entries. If they don't balance, your books and financial statements will be inaccurate. Now that you know what a ledger is, what information can be obtained with this? It provides the necessary information to create financial statements like your business balance sheet, cash flow statement, and income statement. In turn, your financial statements can give you a clear snapshot of your business's finances.
When it comes to 5 main account types in a general ledger, we have the following. First, revenue. These are payments made to the business by customers for the goods and/or services provided by the business. Second, owner's equity. The theoretical value of the business that would be distributed to the owners after the assets were sold and the liabilities paid. Third, expenses. Costs incurred by the business in providing the goods and/or services purchased by the customers. Fourth, liabilities. Monies that the business owes to the non-owners. And lastly, assets. Items of financial value that the business controls or owns for the purpose of producing income for the owners.
After knowing about the general ledger, let us talk about the accounting cycle. The accounting cycle is a series of steps used by an accounting department to document and report a company's financial transactions. The cycle follows financial transactions from when they occur to how they affect financial documents. The accounting cycle happens every accounting period or reporting period for which financial documents are prepared.
The accounting cycle begins with transactions and ends with completed financial statements. The first step is to journalize the transaction. The journal is a chronological list of each accounting transaction. After journal entries are made, the next step would be posting the entries into a ledger. Posting refers to the process of transferring entries in the journal into the accounts in the ledger. Posting to the ledger is the classifying phase of accounting. An accounting ledger refers to a book that consists of all accounts used by the company. the debits and the credits under each account, and the resulting balances.
While the journal is known as books of original entry, the ledger is known as books of final entry. Once all journal entries are posted, the ledger balances are posted to a trial balance, which is a list of all the accounts and balances, checking to see that the total of the debit column is equal to the total of the credit column. Each account is then checked for accuracy and adjusted, if needed to be, before the financial statements are run. This process is referred to as the accounting cycle.
To keep your records accurate, you should post to the general ledger as you make transactions. At the end of each period, transfer journal entries into your ledger. Use your ledger to classify and organize transactions. When posting entries to the ledger, move each journal entry into an individual account. The accounts, called T-counts, organize your debits and credits for each account. There's a T account for each category in your accounting journal.
Transfer the debit and credit amounts from your journal to your ledger account. Your journal entries act like a set of instructions. When posting journal entries to your general ledger, do not change information. For example, if you debit an account in a journal entry, debit the same account in your ledger.
Keep in mind that your general ledger lists all the transactions in a single account. This allows you to know the balance of each account. But to find the balance, you need to do some math. After posting entries to the ledger, calculate the following balances. For the asset and expense accounts, you need to subtract total credits from total debits. For the liabilities, equity, and revenue accounts, you need to subtract the total debits from the total credits.
If you don't want to mess with the calculations yourself, consider investing in accounting software. With accounting software, you can record transactions in your ledger and the software handles the calculations for you.
If you're a little lost, don't stress. Instead, follow these steps to post journal entries to the general ledger. Number 1. Create journal entries. Number 2. Make sure debits and credits are equal in your journal entries. Number 3. Move each journal entry to its individual account in the ledger. For example, checking account. Number 4. Use the same debits and credits and do not change any information. And finally, number 5, calculate the account balances in your general ledger.
Hi everyone, today we're talking about the general ledger, and I'm your instructor Brandy. The ledger is the next step in our accounting cycle. You've already watched a video about how to get transactions into a journal by making journal entries. Now we're going to take those journal entries and put them into the ledger. And what the ledger is a chronological listing of all the transactions in one account. So we'll have a ledger account for cash, we'll have a ledger account for accounts payable, we'll have a ledger account for revenue, and so on. In a previous video, you looked at these examples and how they got into the journal, and we made these journal entries. Now let's put these journal entries into the general ledger. So this is what our general journal is going to look like. For each account, we're going to have a listing of all the transactions within that individual account. And we're going to keep a running total of the account balance, so at any point, we can make the financial statements from the general ledger balances. Let's see how we put our transactions from the journal entries into the general ledger. So the first account we're going to deal with is cash, and it has a debit of $10,000 on January 1st. So let's put that into our ledger. I go find my cash account. The date was January 1st. We're going to debit for $10,000, and the balance in the account right now is a $10,000 debit balance, because we only have one transaction in this account right now. And I'm going to go back to my journal entry and I'm going to check that off as being done. So I know that I don't have to deal with that anymore. Now going down the list, I can go to the capital account and it has a credit for $10,000 on January 1st. And I go back to my journal and I check that off as being completed. The next transaction, I've got car debited for $5,000. Go down, find my car ledger, date January 3rd, debit $5,000, and the balance in the account is $5,000 debit because there hasn't been any other transactions. I'm going to check that off as being done. The next one, accounts payable credited for $5,000 on January 3rd, and check it off as being done once you've completed it. The next item down the list is advertising expense debited for $100 on January 5th. The next item is cash being credited for $100 on January 5th. Now it's important not to make a new ledger account for cash. Use the ledger account that's already in use. Now when we update the balance account, we have a debit of $10,000 and a credit of $100. If there's two debits, add them together. If there's two credits, add them together. If there's a debit and a credit, subtract them. So in this case, we have a $10,000 debit minus a $100 credit gives you a debit balance of $9,900. And check that off once you're done. The last journal entry, we've got debit accounts receivable for $250 on January 7th. And the last account, service revenue, is being credited for $250 on January 7th. So when we're all done, this is our general ledger. So now you know how to post transactions to the general ledger. Thanks for watching.
So why are ledger entries so important? It keeps you organized, makes it easier to find transactions, compartmentalize transactions, let you see the big picture of your company's financial health, show you patterns in income and expenses, helps you catch accounting mistakes in your records. Keeping your ledger up to date can help you avoid penalties and ensure that your records give you an accurate picture of your business's finances. Have you learned a lot from today's lesson? Make sure to leave a like and a comment below. Please subscribe for more lessons like this.